So here we are in our last module, and I decided to move the lecture a little bit. And the last thing we're going to do is look at how we account for investments on an ongoing basis under these different scenarios. So remember, we've got the basic accounting ideas about what we do. So for example, if we have marketable securities that are trading securities, then we know that's going to be the gains or losses on those are going to be included in income, whereas the available for sale ones are going to be written up or down but not included in income, and the held to maturity are just at this modified cost basis, and then there's the equity and the consolidated one. So we have the basic accounting rules, but then we have the issues to deal with, which is the subject of this last module, which is what do we do with each one with all the different transactions that affect them as things go along. And so let's go through those briefly and illustrate those. And we'll start with the trading securities. So remember, trading securities, we're dealing with pretty much marketable equity securities that we buy and sell on an ongoing basis. So if you think about it in terms of the accounting equation, we have assets equals liabilities plus owner's equity. And under owner's equity, we're going to have this retained earnings column that will have our revenues and expenses and gains and losses in them. And so originally, the first thing that happens is we buy some marketable securities. So step one, we buy. And so we add 10 here. Let me move that over here. Let's do it this way. So we've got cash and we've got investments. And the specific investments, this would be our trading securities, marketable securities, which would be accounted for as a short-term investment, right? Okay, so cash, we've got minus 10 and investments plus 10. All we did is trade one kind of asset for another. Now, if we're an investor in this, it might go up and down in value. So let's suppose that it goes up. It's a trading security. Let's suppose it goes up from 10 to 11. What's the rule? Show it as income, right? So unrealized gains on trading securities. So we've got this unrealized gain. It could be a loss, and maybe later it'll go down. So we can adjust it up and down. So this is going to be plus 1 here. And under here we'll have a plus 1 unrealized gain of some sort that will show. Now this may be a stock that issues dividends. So the other thing that's going to happen is that we receive dividends from it. And we receive dividends, let's suppose dividends are 0.1. All right, so here's dividends. Dividends received are just treated as income to us at the point they're received. So we would have plus 0.1 here. And out here we would have plus 0.1 that would be investment income. At this point, what's the value in the investment account? Is it 10? No, it's 11. So now let's suppose we sell it for 12. All right, sell. And that's our final transaction. Sell at 12. What happens? Cash goes up by 12, right? Investment goes down by only its cost, 11. And what's the other one? Is, right, we have a gain on the sale of the investment. Now, if you net out the 1 unrealized gain, we actually have 2 realized gain, right? So we actually have a full realized gain now of 2. Before, 1 of it was unrealized, and now in total we have 2 that's been realized. 1 was unrealized previously. So that is our trading securities. Okay, now let's look at available for sale securities. So remember, under available for sale, under available for sale securities, we're doing basically the same thing except that we're not recording the unrealized gain or loss on the income statement. The actual procedure that's used is that the company will evaluate. It's not like they go through and just willy-nilly revalue assets, investment assets during the year. They wait till the end of the year, and then they do an analysis and show any net unrealized gain or loss and make an appropriate adjustment for that. The example we're going to go through, we'll just assume there's just this one, but you'll see how it works. So, available for sale, right? It's, again, marketable equity securities, but we're not planning to sell them, but we might. And so what do we do with them? The first thing that we do in one is we buy at 10. So once again, we have cash and investments. So this is what? Minus 10 and plus 10. Just trading one asset for another, correct? And let's do our dividend next. Because we want to do the adjustment related to the evaluation of the unrealized gain or loss at the end of the year. So the next thing that happens is we get our 0.1 dividend. So that's really identical here. Dividend of 0.1. So cash goes up plus 0.1. And under owner's equity, we have our retained earnings column, which is plus. It's plus 0.1 investment income. And then at the end of the year, we go and evaluate our investment accounts, and we figure out it's worth 12. Okay? And so at 12, we go and we make our adjustment. We say, well, 12, and it's only on the books for 10, so we're going to write it up by, let's just write it up to 11 at the end of the year, all right? Because I want to do the sale at 12 later. So, just like in the last one, we write it up to 11, so we say, all right, so there's plus 1, which is the write-up, but now we're going to have some kind of, I'm going to put in a separate column here that I'm going to call it just adjustment, but it's still part of owner's equity. And I'm only doing this, even though it really does go directly into retained earnings. It's like a special adjustment. I don't want you to get confused and think it's part of the revenue and expenses and gains and losses, because it's not. So the additional 1 goes in here, although these two accounts really, the way I'm showing them, are kind of go together. They do go together. So it would be an increase in retained earnings, which would be the other way to show it, but it's not included when you could do your income statement. So that's the difference. And that's the end of the year, okay? So the next thing that happens is that we sell. We have to sell this thing, and we sell it at 12. So if we sell it for 12, then what's going to happen? We're going to have, this is on the books at 11. We're going to still have 12 here, right? Right? And this is going to go away for 11. And we're actually going to get rid of this 1 here. That's one of the reasons I want to show it here. This is a special adjustment. This unrealized gain or loss is going to go away, and we're going to have a realized gain of 2 here. So this is gain on sale. So that unrealized gain that was sitting there not as a part of net income disappears entirely, and the full 2 will show up as an income statement item. But see, here's the difference. It only shows up as an income statement item at the point it's sold, whereas under the trading security approach, whenever the valuation is bigger or smaller than what is on the books at, it shows up as an unrealized gain or loss. So that's the difference between the trading securities and the available for sale. Okay, so when we move to the, I'm not going to spend any time really going on the held to maturity, because that's basically accounting for bonds. And so under bonds, I'll show you briefly. So under bonds, suppose we buy some bonds, all right? If we buy the bonds at 10, it's still the same thing. You know, we got the investment in cash. The thing that might change it here is there might be a premium or discount. Remember, premiums occur if the means we pay more than the face value of the bond. That's a premium. When will we do that? When the rate of interest on the bond is higher than the market rate. So we like that bond, and we'll pay a higher price for it. Or if the rate of interest on the bond, if the coupon rate is lower than the market, it'll sell at a discount because, you know, who wants that rate of interest? So what we do is we're going to amortize off the premium or discount as an adjustment to interest expense over the life of the bond. We're not going to do that. We're not going to fuss with that. We're just going to deal with it. Assume we bought the bond at face value, all right? Keep it simple, at par. And then the only thing we have to deal with is the interest income that we receive on the bonds. Because remember, we get cash interest in the bond every 6 months or every year. So whenever we do, we're going to get cash of whatever, 0.1. Here's the interest received, because these are bonds, right? It's not a dividend, it's an investment in a bond. So plus 0.1, and out here we'll have a plus 0.1 as investment income. So we just treat that, any of the interest we get, any of the interest income we get is investment income. So under the available for sale trading securities and held to maturity securities, oops, remember these are now, this is our HTM group, these are our bonds. Under all these methods, any checks that are written to us from the investee, the company writing us checks for being dividends or interest, that's just income. That's just investment income. They're all the same that way. And that only changes when we get to the equity method. Now remember, the equity method is when we own 20% or more of a company. Let's see how that works. So, the first thing is that we buy a company. Now we're going to use the equity method. This is only for, in general, 20% plus ownership. And so what do? The first thing is that we buy some of the company. We'll assume that that's at least 20%. Let's say it is 20%. We need a percentage so that we can do our math here. So this is, so we buy 20%, and it costs us 10. And so cash goes out for 10, investment goes up by 10. So long-term investments, not current, right? But notice that once again, it's just recorded at cash, recorded at cost. All these things, when we buy an investment, we originally record them at cost. So we got it at 10. Now, at the company's year end, the company announces that their income is like, let's see, let me think of a good number, 50. Let's suppose they're, no, that's not a good number, 50 to 20 is a, let's suppose they announce that their income is 20, all right? So this is just their announcement. They're not paying us anything. They just say, they issue their financial statements on their, in the bottom line on the income statement it says net income 20. Okay, so the announcement is net income of investee, in other words, the guys that we paid 10 for, is 20. Well, how much of the company do we own? 20%. Good. 20%. So if we own 20%, how much of the 20 is ours? 4, right? So we really, now we're not getting any cash, remember that, no cash. But we say that under the equity method, the value of our investment is increased by our share of the investee's net income. Again, think of the bank account. You have a bank account, you earn interest on the income on the bank account. How much is in the bank account? Well, whatever you paid plus the interest, even though you haven't taken it out, that's how much it's worth. Same thing. So we really have a plus 4 here, because that's right, that's just 0.2 times 20 equals 4. And then we would show that over here, plus 4 as investment income. Again, we not get any cash or anything like that. Nuh-uh. Then the company actually does pay a dividend. Suppose they pay a dividend and we get 1 as our dividend. So here's what happens. Dividend of 1 to us. Well, that's cash. We got cash, so we got plus 1. But we don't call that investment income. Again, imagine if you went to the bank and you withdrew money from your savings account, would that be income? No. You're just withdrawing some of the investment you have in your bank account. You're really, when you get a dividend under the equity method, you view it as if you just took out some of your investment in that company. So it's not over here. It's here. See, we're taking some of the money out, like we just took to give us some of our money back. That's all. So now, at this point, assuming that we're ready to sell this long-term investment, we would say, well, what is the value here? 10, what we originally paid, plus our share of the company's net income minus the dividend received. 10, 14 minus 1 is 13. Suppose we sold it for 12.